All right, welcome back. We are now proceeding with question 4. We are still on the same paper, that is November 2020 in bracket 2 exam. We started by doing question 3. I hope you have all captured it correctly. And we are now proceeding with question 4. Then after question 4, we will then decide which question to go back to. But our intention is to ensure that we do this whole paper and finish it. And the reason why I started with these 3 and 4, it's because the observation when we are marking accounting scripts is that most of these learners, they leave this question blank and they tend to rush and do the income statements and the balance sheet where there is a lot of calculation. And where there is theory, they just ignore because they believe that theory is difficult, whereas it is the most easiest, so long as you have the right interpretation and you know the concept and you are clear with what you are doing. The chances of getting it 100% correct, they are very high. So that is why I would invite that you pay undivided attention as we are now doing question 4, which is a new question, because these questions were not there in our previous papers, the 2019s, the 2018s, and the 2017s. So this one is almost a new question, which is corporate governance, question 4. Question 4 was based on corporate governance. Shareholders and employees associated with the company will be particularly interested in whether the company is well governed and managed by the directors. At the AGM, the shareholders will elect 2 types of directors. The first type of director will be the executive directors. The executive directors, they attend board meetings and they work at the company on full-time basis. It is very important that you clearly understand the difference between the 2 directors. There is executive directors and there is also non-executive directors. So the executive directors are those that they attend board meetings and they work at the company on full-time basis. They are permanently employed by the company and they are working on full-time basis. But the non-executive directors, they also attend board meetings, but they do not work at the company. Those are the non-executive directors. So you are provided with 4 aspects of corporate governance that will be of a concern to the stakeholders. 4.1, that's the audit report, which is 4.1, the audit report. The first question in 4.1, it says, explain why a qualified audit report is not a good reflection of a company. Provide 2 points. Remember, after a thorough audit that will be conducted by the independent auditors, the independent auditors then write a report. And the reports that we may expect from the independent auditors, they vary. The first one that all companies are always expecting is an unqualified report. And an unqualified report is an excellent report where everything in the company has been done correctly, where the financial statements are in accordance with the GAAP and they are in the manner that is required by the Companies Act. There is also a qualified audit report, which is not a good report. A qualified audit report is not a good report because this report is indicating that maybe 1 or 2 aspects could not be verified. Maybe there is information that is missing and therefore the auditors will then issue a qualified audit report. There is also a disclaimer of opinion report, a disclaimer which is a very bad report. A disclaimer of opinion when it is issued by the auditors, it is when the financial statements are not in compliance with GAAP, they are not in the manner that is required by the Companies Act, they did not even comply with the International Financial Reporting Standards. So the disclaimer is a very bad report. But our first question under question 4, here it says, explain why a qualified audit is not a good reflection of the company. Provide 2 points. So I think from what I've been explaining, you can be able to provide an answer. When it says it's not a good reflection of the company, it's because this report indicates that there is information. It indicates that some information is unclear, or maybe there is an information that is missing. Some information, it indicates that some information is unclear, it's not clear, and maybe that there is information that is missing, which is not a good reflection of the company. And this may result to a company losing. The company may lose potential investors. If the potential investors see that this company has been given a qualified audit report, so they may not want to invest in that particular company. So this company may lose potential investors. And we are not looking at it in the point whereby it's losing the potential investor. They may even lose the existing shareholders. When the existing shareholders get to realize that they have been issued with an audit report, so therefore they may decide even to leave the company if they have been issued with a qualified audit. So this qualified audit report has got a very negative impact on the company. Even when the company is applying for loans in the bank, they may not be granted loans because of this qualified audit report. They may even be charged when it comes to things like when they are submitting for their tax returns. They may not get, they may not save money from their taxes because it is clear that some of the information here is missing and is not there. And this is also reflecting that there is lack of internal control, which is a very important point. This qualified audit report is showing that there is a lack of internal control. This is another point that you may include, because if there is proper internal control in the business, therefore the company may not get a qualified audit report. So let us then proceed to 4.2.